Why China and the US still need each other. Now more than ever. Everyone's talking about a US-China divorce, tariffs, tech bans, trade wars, asset freezes, Cold War 2.0. But here's the truth. No one's saying out loud, the US and China still need each other, badly. They're locked in the most complicated economic relationship in modern history. Enemies on paper, partners on spreadsheets. In this video, we'll break down why decoupling is harder than it sounds, why both economies are deeply dependent on each other, and what's really going on behind the headlines. Let's get started. Chapter 1. China buys the US. Literally, let's start with the obvious. China holds US debt. A lot of it. Roughly $775 billion in US treasuries. Why? Because when China sells goods to the US, it receives dollars and needs somewhere to park them. The safest place? US government bonds. In fact, China's purchases have helped fund US spending for decades. You want low interest rates? A strong dollar? You need buyers, and China's been one of the biggest. Without China in the mix, borrowing could become more expensive in the US, especially as deficits rise. Chapter 2. The US buys China's growth. Now flip it. The US buys more from China than any other country on Earth. Over $500 billion a year in imports. That money fuels China's manufacturing sector, creates jobs, and keeps the Chinese economy growing. From smartphones to solar panels, U.S. consumers are China's best customers. Yes, reshoring and tariffs are changing the equation. But make no mistake, a full breakup would hit China's GDP hard. Especially now, as youth unemployment is high, property markets are shaky, and foreign investment is slowing. Chapter 3. Supply chains are still intertwined. During COVID, we learned how fragile supply chains really are. And yet, they still run straight through China. Semiconductors, rare earth metals, pharmaceuticals, lithium batteries. Even products labeled "Made in Vietnam" often include components from China. Meanwhile, China still needs U.S. agricultural products like soybeans and corn, and high-end technology like chips and advanced software. The idea of complete decoupling? It sounds good on a podium, but it's nearly impossible in the real world, at least in the short term. Chapter 4. Why both economies are vulnerable. Right now, here's the real twist. Both the US and China are entering a fragile phase. In the US, inflation is still elevated, debt is piling up, and interest rates are at decade highs. In China, real estate is collapsing, youth unemployment is soaring, and growth is slowing fast. This isn't a time to pick fights. It's a time to stabilize, or risk global contagion. If the US stops buying, China slows. If China retaliates, US supply chains break. Lose, lose. Chapter 5. What would happen if they really split? Let's play it out. If the US and China fully decouple, prices in the US would spike. Cheaper goods would vanish. US companies like Apple, Tesla, and Nike could lose access to critical factories and markets. China would face mass layoffs, a falling yuan, and capital flight. Global markets would panic. Currencies would swing. Investors would flee risk. In short, nobody wins. The world is too interconnected for a clean break. Final thoughts. The US and China aren't friends, but they're not going their separate ways either. Not yet. They're strategic rivals who can't afford to fully disconnect, and they both know it. That's why every sanction, every tariff, every threat comes with a counterbalance. Because deep down, both sides understand one thing. If they bring each other down, they might bring down the world economy with them. Thanks for watching Finance Related 101. If you found this helpful, hit the like button and subscribe for more real-world economic breakdowns. And comment below. Do you think the US and China are stuck together? Or can they actually decouple? Let's talk about it.